Somebody already knows where your stop loss is. Not in a conspiracy way, in a boring, mechanical way. The high of yesterday's candle and the low of yesterday's candle are the two most crowded prices on your chart, and every trader who bought a breakout or sold a breakdown has left an order sitting just beyond them. Price goes there. It always goes there. The only question is whether you're the one being collected or the one waiting on the other side when it comes back. That's the entire idea behind candle range theory, and it's usually taught so badly that people give up on it. So today, I'm going to strip it back. You'll get the model in 3 candles, the one rule that invalidates it instantly, a version that trades with the trend instead of against it, and exactly where the entry, the stop, and the target go. 12 minutes, and you'll be able to run this on any pair, on any time frame tonight. Part 1. A candle is a completed auction. Start with a reframe, because this is what makes the rest click. You've been taught to read a candle as a bar with a color. It isn't. A candle is a finished auction with 2 edges, the highest price anyone was willing to pay in that session, and the lowest price anyone was willing to accept. Those 2 edges have names in this model: the candle range high and the candle range low. And here's the proof it matters. Take any daily candle and drop it to the 15-minute chart. You'll see that its high and its low weren't random touches. They were turning points. Price went there, failed, and reversed. That's what makes them liquidity. Everyone can see them. Everyone uses them as reference, and stop orders pile up just beyond. Which means you can identify the 2 most important prices for tomorrow without opening a single lower time frame. 1 candle, 2 lines. That's your map. And this is fractal, which means it works on any candle, on any time frame. A monthly candle, an hourly candle, a 1-minute candle. What changes is weight. A daily range holds far more resting orders than a 5-minute range, so a daily sweep moves price further and matters more. Pick your range candle on the time frame you actually trade, and treat the higher time frame ranges as the levels your trade has to travel through. Part 2. The model in 3 candles. The setup is 3 candles, and each one has exactly one job. Candle 1 defines the range you mark its high and its low, and then you leave it alone. Candle 2 is the sweep. It pushes beyond one of those edges, grabs the order sitting there, and then closes back inside the range. Candle 3 is your entry, and your target is the opposite edge of candle 1. Sweep the high, target the low. Sweep the low, target the high. Now, the rule that decides everything, and if you take one thing from this video, make it this one. It has to be a wick out and a close back inside. A wick beyond the level is a rejection. The market tried that price and refused it. A body closing beyond the level is acceptance. The market tried that price and agreed with it. Rejection is your setup. Acceptance is expansion. And expansion in the direction you are about to fade is how accounts die. So the discipline is simple and it's boring. You wait for the candle to close. Not the wick forming, not price looking like it's coming back to close. Half the people who say this model doesn't work for them are entering while candle 2 is still alive. And a candle that looks like a perfect sweep with 10 minutes left can finish as a full-body breakout. Let it print. The setup isn't going anywhere. Part 3. The New York play, and why it's only half the answer. The most popular way to run this is on the 1-hour candle just before the New York Open. The logic is sound. London builds a range and pushes price one way. The New York arrives with real volume, takes the liquidity London created, and reverses. So you mark that pre-New York candle, and if price sweeps outside it and closes back in, you've got a sweep with a session catalyst behind it. But be honest about what that trade is. You're fading a move. You're counter-trend by definition, and counter-trend trades ask you to be right about timing to the minute. They work, but they punish hesitation, and they're a rough place to build confidence if you're still learning. So here's the version I'd actually give a newer trader, same model, same logic, pointed in the direction the market is already going. Part 4. Trend-aligned CRT. 3 steps. Step 1. Identify a clear trend and find the impulse leg, the aggressive move that created the direction. Step 2. Wait for the correction. You are not trading the impulse. You are waiting for price to pull back inside it, because that's what gives you a good price and a tight stop. Step 3. And this is the trick inside that correction. You only mark candles that oppose the trend. In an uptrend, that means bearish candles only. Mark the high and low of each red candle. Then, watch the next one. If the next candle breaks below and closes below, that range is dead. Move on to the next red candle and repeat. But when you finally get a candle that dips below the low and closes back inside, that's your signal. The pullback just took the seller's liquidity and failed. You've got the range, you've got the sweep, and you're pointed the same way as the trend. Flip it for a downtrend and add one more filter, because this is where the setup goes from good to genuinely selective. Split the impulse leg with a Fibonacci and look at the 50% line. In a downtrend, you only want to be selling from above it, from premium. So you wait for the correction to lift price into premium, and only then start marking bullish candles and hunting for a sweep above their highs. Trend direction, liquidity grab, and a discounted entry price, all stacked on the same trade. Part 5. Entry, stop, and targets. You could just buy the close of the sweep candle. It works, and if you're busy, take it. But you're paying for that simplicity with a wide stop, because your invalidation is all the way down at the sweep low. The better version costs you 5 minutes. Drop to the 5 or 15-minute chart and look at what the sweep actually looked like up close. What you'll almost always find is that the reversal out of the sweep left a fair value gap, a 3-candle imbalance where price moved so fast one side never got filled. That gap is your entry. Set a limit order in it. Put your stop just below the gap or below the sweep low, whichever is tighter while still making sense, and now your risk is a fraction of what it was. Same idea, same trade, a much better price. For management, keep it mechanical. Close half at 1-to-1 and move the stop to entry. The trade is now free. And psychologically, that matters more than people admit, because a risk-free runner is a position you can actually hold. Let the second half go to the opposite edge of the range, or the next obvious high or low if you're trading with the trend. And if you get more than one gap on the way down, you're allowed to stack a second limit rather than cancel the first. Part 6. The 3 ways this breaks. Mistake 1, and it's the big one. Running this in chop. In a range, every candle sweeps something. So every candle looks like a setup, and you'll take 6 trades that all mean nothing. CRT needs a readable impulse and a readable correction. If you can't point at the impulse leg in under 3 seconds, there isn't one close the chart. Mistake 2. Entering early, which we covered, but it's worth repeating because it's the most common one. Reversal looking is not the same as closed back inside. Mistake 3. Ignoring context. A textbook sweep can be run straight over by a rate decision, a CPI print, or a daily support level sitting 20 pips away. Before you take the trade, check the calendar and check the higher time frame. If there's a major level between your entry and your target is wrong. Let me show you what a realistic run actually looks like, because this is the part that gets edited out of most videos. On a trending pair, you might mark 4 red candles before one of them produces a clean sweep. You take the trade, it runs. You bank half at 1-to-1. The next setup forms 2 days later. It also triggers, it hits your first target, and then it turns around and stops you out on the runner. That second trade is a break-even, not a loss, purely because you took half off. 2 setups, 1 winner, 1 scratch. That's a normal week, and it's still profitable. And 1 expectation to set honestly, because I'd rather you hear it now. Not every one of these wins. A backtest where everything works is a backtest that's being edited. What you're building here isn't a perfect signal. It's a repeatable reason to be in a trade, with a defined invalidation and a stop that isn't guesswork. That's what an edge actually looks like. Let's compress the whole thing. Every candle is a range with 2 liquidity edges, a sweep of 1 edge that closes back inside points price at the other edge. Only traded inside a clear trend, only on candles that oppose the trend, and in a downtrend, only from premium. Refine the entry with a fair value gap on the 5-minute, stop below the gap, half off at 1-to-1, and let the rest run. Your job this week is 1 chart and 20 setups. Pick a pair, go back 2 months, and log every range candle you find inside a correction. Write down whether the next candle closed inside or outside, and what happened after. You'll learn 2 things fast: how often the invalidation rule saves you, and how much of your old losing pattern was just entering before the close. That's not homework. That's the entire difference between knowing this and using it. If this made the model make sense, subscribe and turn on the bell. Next week. I'm breaking down how to pick which candle to use as your range on a higher time frame, which is the question everyone asks after this one. Tell me in the comments which pair you're testing it on. Not financial advice. Trading carries risk. Manage your risk, 1 to 2% per trade. See you in the next one.